Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Bond and currency traders await today's U.S. jobs report, with investors almost fully pricing in a Fed rate cut this month. A Bloomberg scoop, China's DeepSeek is working on an AI model with more advanced features to compete with U.S. rivals, including OpenAI. And oil on edge as traders await an OPEC Plus meeting that could see the group sign off on another supply hike. It's just gone 8 a.m. across the Emirates. I'm Joanna Bersace in Dubai, while traders around the world are bracing for today's jobs figures. Feels like we've been leading up to this all week with a lot of gyrations in markets, but fixed income rally coming back yesterday. We've got 10-year treasuries back now to, well, this is the 2-year, but 10-year treasuries are back to 4.2%. At one point, we were talking about a major sell-off earlier on in the week. But the point is, today's figures are going to be key in terms of where we go from here, rate cuts. September is pretty much baked in. If we get perhaps a much weaker number, then the markets may be quick to price in an even faster and more aggressive rate-cutting cycle. This is the picture, though, for today. Equity futures leaning towards the green. Another record high for the S&P by the close yesterday for Wall Street. 2-year yields is what we have on the screen, 3.58, and we've got 1 rate cut priced in for September, but 5 cumulative by the end of 2026. The USD is slipping. We're down 16 basis points today, down about 0.7 for the month, and then, of course, down almost 10% for the year, down 9.5% for the greenback. So we continue to talk about weakness in the USD. And then Brent, all eyes on this OPEC Plus, a group of OPEC Plus. The voluntary cutters are going to be meeting, a virtual meeting this weekend. There is talk potentially about this other clip of 1.66 million barrels per day that they've been taken off the market. Maybe they'll start talking about bringing it back, but of course, fundamentals will dictate where we go from here. And many in the analyst community are expecting to see a supply glut on the oil side in the coming months. So keep an eye on the OPEC Plus decision this weekend. Okay, let's also check in on how markets in Asia are faring. Annabelle Jewelers is in Hong Kong. Annabelle.
Thanks, Jemani. I mean, I really think Asian markets are reflecting already those themes you were talking about. It's all about the Fed, what the Fed does, but the US jobs report coming up later today. So just talking through some of the dynamics, I mean, you can see here sovereign bonds, for instance, you're seeing that general pullback in yields. It echoes what we had with the 2-year Treasury that, again, retreated overnight down to its lowest level in around a year. You saw dollar weakness, for instance. That's playing out because you're seeing a lot of Asian strength in the currencies today. And also what we're seeing in terms of stocks, because Taiwan dollar is up, we're actually seeing more inflows coming into Taiwanese equities. So that benchmark has been one of the gainers in the session. You can see here futures, for instance, up 1.1%. Japan also one of the standouts. We had President Trump signing an executive order to bring that tariff deal or that trade deal into effect, and watching China very closely today, given you've got that maybe day 2 reaction. We had the Bloomberg scoop yesterday. Lots of questions around regulators. Would they be looking to step in to try and cool down that rally? We haven't really had any concrete steps just yet. Maybe there's been sort of a self-correction in the market, but still we're high for a first session, really, reversing some of the earlier losses from yesterday. It is interesting to note, though, as we do await these jobs figures, just how much volume we're seeing. Because if you pull up the AVAT function, for instance, you can see that we're off the 20-day moving average. And so that just tells you, I mean, maybe there's a little bit of caution in the market. Investors really want to see what these jobs figures tell us in order to know what the Fed is going to be doing next as well.
Yeah, and it's almost one of those cases where as U.S. stock markets continue to make record highs, liquidity volumes are drying up. There's less participation in those moves. So we're going to talk about that and more. Annabelle Jewelers in Hong Kong, thank you so much. Well, bond and currency traders are bracing for this crucial jobs report that is due in just a few hours. The data is expected to shape market expectations for Fed policy. Joining us now is Gareth Nicholson, Chief Investment Officer and Head of Managed Investments at Nomura International Wealth Management. Good to have you with us, Gareth. Let's talk about today's print. I feel as though the market whisper is probably a low number. Expectations are around 75,000, but given last month's shock, we're probably all biased towards seeing a weaker number today. What do you think the market reaction would be if we get a slightly lower print than that 75,000?
Lower than 75? Wow. Okay. I think you're right. Like, normally what we're looking for is the change. Is it an increase or a decrease from the previous month? But you're right. Now it's about what the absolute number is. If we're less than 100,000, that would be the fourth print in a row. That's very telling. I think that would almost guarantee, from a market's perspective, a rate cut. If we're less than the 75, like you're talking about, I think that starts moving the question into, is this an insurance cut or is this a growth scare and the Fed is behind?
Okay, so a 2-week number would actually constitute a growth scare.
Yes.
It would constitute a change in narrative, do you think?
And then equity's going to start thinking, wait, maybe our price to earnings isn't pricing in this growth scare. We might get a bit more of a sell-off. So the sweet spot is between 75 and 100, we believe. Anything less than that, we're going to start worrying about, is the Fed behind? How far are they behind? Are they going to have to start cutting quicker?
Yeah.
What's going to happen to the market? Are we thinking recession? And then the market, we run ahead a little bit too quickly. So I think the absolute number today is going to be very interesting.
Okay, so all of that is going to impact the front end of the curve and what's priced in. 10-year yields plus, you know, that's all been in focus earlier this week. And a couple of days ago, everyone was talking about the global big fixed income bond route. And now we're sitting at lower levels than where we started the week. 10-year Treasury is actually at 4.15, another big rally yesterday. What's your view on market direction from here in the 10-year part of the curve?
Well, long bonds. I think long bonds, like you said, 10-year and above is going to be the most interesting for traders. That's going to get the most bang for its buck. But really, I think it's going to come down to credibility. So in the US, there's credibility around the Fed, around what the president is interacting. There is new interviews going on for potential Fed chair.
Yeah.
In France, you've got the vote of confidence coming in next week, which is also going to put pressure on the long end. Japan 30 years bonds are at the highest level we've seen in multiple decades. And I think this is all coming down to, does the market believe that central banks can control this level of debt, can control this supply that they need to keep the wheel turning? And there's questions there. So steepening of the curve is our base case.
Yeah.
That's going to put pressure on many different parts of government to fund the future. And it's quite nerve-wracking because that is normally seen as the foundation for markets, and it is shaking a little bit.
Yeah. How much of a systemic impact do you think the French budget issue could have? The confidence vote is coming up next week, obviously, and the government there is expected to collapse once again, raises lots of questions about who the next PM is going to be, possibly elections. You know, all of that is a very domestic French story. But there has been an impact and a visible footprint on the bond market. Is that likely to affect other European bond markets as well, or is it going to be rather contained to French spreads?
The way we're thinking about it is when we looked at what happened in the UK around
the mini budget?
Exactly.
Yeah.
That was a local issue that kind of ran away from itself, and we saw a lot of pressure being put out. Now you've got the second biggest economy in Europe, potential conflict there. You already started seeing spreads between France and Greece being highlighted. That's something you wouldn't have thought of. So I think it's going to put a lot of pressure on that space. And we know that Europe needs to do a lot of funding. They've got defense funding to do. They've got a lot of infrastructure funding to do. So they need access to funds. And if the long end is going up, that's going to make it a lot harder, particularly in the second biggest economy. So also very important to keep an eye on that and make sure that doesn't run away.
Let me bring it back to equities and something that my colleague Annabelle was pointing out, and the fact that with the Asia Pacific MSCI, and I think it's the same theme with the S&P, even though we get higher and higher and we're ticking higher, the volumes accompanying those sequential highs and record highs, and when it comes to the S&P, have been thinning out. And I just wonder whether, from your perspective, the clients that you speak to are losing some of their long-term conviction vis-a-vis U.S. equities, or whether they feel like they're positioned enough and don't need to chase this rally any further.
I think a lot of our clients are overweight U.S. They have been for a long time. It's been a great trade. As you said, breadth is narrowing in where the performance is coming, volume is going down. We're also seeing, I mean, I don't honestly believe the NVIDIA earnings were bad by any means.
No.
I mean, they were pretty solid. But when you've got a PE ratio like that, you need amazing to see the same sort of level. So when you're getting to these kind of price to earnings, you need very, very strong numbers to come through. So top performing AI that can monetize, some of the defensive names, that barbell, we still see value. But there is a lot in between that needs rate cuts for insurance, not for growth scare. They need a few tailwinds to keep that momentum going. Our base case is it's still going to grind up higher equities for most of this year. But next year, it's going to be a lot harder to keep the momentum.
So I'm sure there's plenty of interest from your clients to invest in the AI world, right? And if you had invested in NVIDIA early on, well done you. But now, as you say, there's valuations, things are looking extremely expensive. You have to be a bit more discerning about which of these AI models, applications are actually going to be successful. How do you screen for them, and how can you ascertain at this point in time which ones are going to be the winners in the next few months or years?
Yeah, well, exactly. That is one of the hardest questions. For one, your earlier point, investors made so much money in NVIDIA in the stock, so they don't mind a bit of a drawback. Buying the dip is still going to be an environment that we're going to see. When you've just done so well for so long, it's going to need a serious scare for people to change their conviction. But any new money, people are saying, where is the next angle? Where is the next interest that's coming through? We're seeing interesting things around adoption of AI into robotics, into healthcare, even into energy efficiency that's playing out quite nicely. A lot of that is also maybe not focused purely on the US, but starting to move into China, into Japan. Those are areas that we're starting to see new money moving out. Or if you've got maturing money out of credit or the like, that money is not really staying in the US. We're starting to see the rotation.
Yeah, ties in nicely to a Bloomberg scoop we're going to cover later on the show, which is that DeepSeek are looking to develop their own AI agents. So again, you know, the focus could be shifting east. Gareth, really good to chat to you. Gareth Nicholson, Nomura International Wealth Management CIO and Head of Managed Investments. Now for a look at some of the other stories we're following. President Trump's pick for the Federal Reserve Board of Governors has pushed back against Democratic concerns that he would do Trump's bidding at the central bank. At his confirmation hearing before the Senate, Stephen Miron affirmed his commitment to Fed independence and pledged to make decisions based on his own analysis. But there were concerns about Miron's decision to keep his White House job while at the Fed.
I have received advice from counsel that what is required is an unpaid leave of absence from the Council of Economic Advisors. And so considering the term for which I'm being nominated is a little bit more than 4 months, that is what I will be taking. As long as that is the advice of counsel, I'll follow the law.
Well, your independence has already been seriously compromised by your statement. You are going to be technically an employee of the President of the United States, but an independent member of the Board of the Federal Reserve? That's ridiculous.
Sources say President Trump will rename the Department of Defense to the Department of War. It's a moniker that has not been used since the 1940s, and Trump is expected to sign an executive order on this today. Now, the changes include renaming the Pentagon's briefing room to the Pentagon War Annex and modifying the department's website and signage. Bloomberg has learned the U.S. Justice Department has opened a criminal investigation into whether Federal Reserve Governor Lisa Cook committed mortgage fraud. Sources say federal prosecutors have issued subpoenas seeking information related to the allegations. Last month, Trump moved to fire Cook before she sued the administration to stay on the job and maintained she never committed mortgage fraud. Still ahead, the oil market remains on edge as investors look ahead to an OPEC Plus meeting this weekend. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. Well, oil fell for a third day, heading for a weekly decline ahead of an OPEC Plus meeting that may see the group sign off on another supply hike. Brent crude futures have retreated by 11% this year due to concerns about a global glut and growing worries over energy demand. Joining me now is Stephen Soshinsky, Bloomberg's Asia Energy team leader. Everyone in the industry, I guess, is keeping a close eye on what happens this weekend with that OPEC Plus meeting. Is there really anyone out there who expects OPEC Plus to surprise the market once again with a decision to bring extra production back to market? Because, of course, there is still a 1.66 million barrel per day voluntary cut that was introduced a couple of years ago that could be up for discussion.
Right. Well, I mean, I think that's a really good question. Who's expecting this increase? Bloomberg, we had a survey of analysts and market watchers, and the vast majority think that the meeting that will be held on September 7th on Sunday will just be a rubber stamping and there won't be an increase. Now, there is a smaller group of analysts, a minority, who thinks that there could be a modest increase to production from the next month. Now, that's actually kind of interesting because in the past, the analysts haven't always been right? We're talking about the surprise hikes that have been happening since April, but they had signaled that those hikes had been finished after those 2.5 million barrels had been entered into the market. Now, the big question is, do they want to add these 1.66 million barrels starting to do that now? Because the plan was to do that by the end of 2026. So there's a lot of wiggle room. You're already in a really frothy market. So is this about, adding barrels to the market because they think that there's still some tightness? Or is this about capturing market share? I think those will be somewhat the topics that will be discussed when they meet on Sunday.
Yeah, and to what extent do you think some of the geopolitical considerations are also going to have to be factored in? We talk about, the ongoing potential discussions between Russia and Ukraine. President Trump has sort of flouted the possibility of extra secondary sanctions on countries that buy Russian oil. He's done that with India, though it hasn't really had a noticeable impact on Russian production. To what extent do you think that could be a determinant of where we go in terms of, one, OPEC plus decision making, and two, the price of oil in the coming months?
I mean, certainly geopolitics is swinging the price of oil quite a bit over the last few weeks, months, years even. I mean, Trump has, and what he says has a large impact. And what happens between Russia, the war in Ukraine, and the pressure the Trump administration puts on certain buyers, in particular India, does also have an impact on global oil flows and the price of oil, not just internationally, but also in the United States itself, something that Trump cares deeply about. Now, I think there's one thing, when you talk about geopolitics and relations between countries, I think one other thing that perhaps OPEC Plus will have to be looking at closely will be tariff and the impact of tariffs, right? Where is the global economy, the health of the global economy? Because that is something that's a bit easier to measure compared to what's Trump going to decide one day and wake up. When you look at the measures and the tariffs on the table, OPEC Plus will be looking, and their analysts will be looking at economic growth or economic slowdown because of those tariffs. So I think that's one of the major factors that there will be in play here, because when you look at China, for example, Chinese demand hasn't been living up to where analysts thought they would be at this time of year. There's been a slump, or not a slump, but there hasn't been the growth that was to be expected. At the same time, you look domestically in the United States, they're going to be seeing what U.S. policies are going to be doing to that market, because the U.S. is a major consumer of oil. And some early indications are that demand might not really be there either, because we've seen an oversized increase in inventories this week at the main Cushing facility. At the same time, you're also seeing run rates at refineries at the lowest level in a few months. So those together also indicate a bit of a weaker market. And those factors, the geopolitics, but also just domestic politics of America will have an impact on what they decide.
Yeah. Stephen Szyszynski, thank you so much, Bloomberg's Asia Energy team leader. We are going to be talking more about energy throughout the rest of the show with some guests who are coming on, so stay tuned for that conversation. But coming up as well, DeepSeek is set to be developing an artificial intelligence model to compete with OpenAI. We have the details next. This is Bloomberg.
Chips and semiconductors, and we'll be putting tariffs on companies that aren't coming in. We'll be putting a tariff very shortly. You probably are hearing we'll be putting a fairly substantial tariff on, not that high, but fairly substantial tariff. Directly through reading about you and studying, knowing a lot about your business, actually. We're making it
President Trump warning of more pain ahead for the chip industry during dinner at the White House with top tech executives. But he clarified that goods from companies that have pledged to boost their U.S. investments will be spared. The White House meeting comes amid AI competition between Silicon Valley and Chinese tech champions. Bloomberg has learned DeepSeek is developing a new model with advanced AI agent features to compete with U.S. rivals such as OpenAI. Sources say the model can execute multi-step tasks with minimal prompts and learn from actions. Let's now bring in Annabelle Jewellers again, Bloomberg's tech correspondent. Belle, good to see you again. Well, you mentioned this towards the end of your markets hit. Just tell us, what is the latest exactly on this scoop we have regarding DeepSeek?
Yes, so DeepSeek, I mean, we know it as the AI company or AI startup inside China. It really caused a stir this year when they announced or released their first reasoning model, R1. But in that time since January, it's sort of been very incremental updates from the company. So getting this scoop overnight was quite impactful for many. I mean, it's been very well read. But essentially, DeepSeek is looking at a new AI agent that they want to try and release by the end of the year. That's what we're hearing from sources. An AI agent, so this is what we've already seen from companies, including inside China with likes of Alibaba, for instance, but Microsoft, OpenAI as well. I mean, we've already had a few of these AI agents being released to the market. The idea of an AI agent, just to give some context, is that it can do more than a typical chatbot like ChatGPT, where you put in a text prompt and it spit out a few sentences. An AI agent is really about acting autonomously and, as you said, executing multiple steps, so it can actually start to kind of act like a personal assistant in a lot of ways. That's what DeepSeek wants to be able to do, and that is what, I guess, we've got from our sources. Big question, of course, what would this AI agent really look like, and will it be so impactful as we saw with the R1 to, again, cause more shockwaves across the global AI industry?
So interesting, right. And then also another story that came out overnight, Broadcom looking to help OpenAI design and produce an AI accelerator from 2026. Is this significant?
Yeah, I mean, this is something that, I mean, certainly we had the Broadcom CEO, for instance, speaking about this customer that they had acquired for their AI accelerator business, and they were talking about it being worth $10 billion. So we didn't actually get the direct reference from the CEO, Hock Tan, to who that was, but we understand from sources that are familiar with the matter that it's referring to OpenAI, and they have joined up with Broadcom now to produce an AI accelerator, as you said, going to be coming into market in 2026, but it's certainly a very lucrative space, one that's dominated by NVIDIA. The question is, of course, you know, can they be competitive against that technology?
Annabelle Jewellers, Bloomberg's tech correspondent, thank you so much for the latest there. All right, let's check in on markets because we've got some of those tech themes playing out in Asia. But of course, a look ahead to the big payroll print that's coming out later today. Jobs markets in the U.S. clearly in focus, with the S&P at an all-time high, yet another record. And as we head in towards that print, S&P futures are leaning towards the green. NASDAQ also up 0.3%. European markets as well looking like they're going to have a more positive start to the session. But of course, where we go from here is a function of what happens later today in terms especially of what is priced in for Fed rate cuts the rest of this year and next year. All right, coming up, oil prices on track for a weekly loss. My next guest says numbness to supply risks from the Russia-Ukraine war could be risky. We'll speak to Livia Gallarati, global crude lead from Energy Aspects, next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Bond and currency traders await today's U.S. jobs report, with investors almost fully pricing in a Fed rate cut this month. A Bloomberg scoop, China's DeepSeek is working on an AI model with more advanced features to compete with U.S. rivals, including OpenAI. And MTN is considering reviving talks to acquire South Africa's Telkom, as Africa's largest wireless carrier looks to close the gap with its rival Vodacom. It's just gone 8:30 a.m. across the Emirates. I'm Joanna Persechi in Dubai. Well, this is your screen for you. You got S&P leaning positive, up 16 basis points, another record high yesterday. Two-year yields at 3.58. So not a lot of movement today. But again, we are trading at the lowest levels in yield terms in the past year as investors continue to price in further interest rate cuts out of the Fed. You've got September pretty much fully baked in for next week for rate cuts, and then another 4 after that for 2026. So it takes the terminal rate to around 3% by the end of next year. Let's see if that changes with today's job figure. 75,000 is the headline number that is expected. So we'll see if any upside or significant downside surprises come after last month's downside shock. USD, you can see slipping this morning as well. So the theme continues to be one of weakness. For the month, the USD is down about 0.7%, but still 9.5% weaker on the year. So investors not giving a lot of love still to the USD. And then Brent in focus, energy. We're going to be talking about that shortly with our guests about some of the dynamics as we head into Q4. Today, we're trading just shy of $67, down 0.2%. Okay, let's move on and check in on how some of these markets in Asia are faring. Our friend Annabelle Jewelers is in Hong Kong. Annabelle, walk us through some of the drivers of the markets today.
Yeah, thanks, Jemana. I mean, I think it's really great there. You just mentioned weaker US dollar, lower oil prices, lower yields. These are all factors that benefit Asian equities. And so you're seeing that reflected in the session today. You've got green here across the screen. Even in China, for instance, yesterday we were talking about that scoop that regulators were getting a little bit worried about the rally moving too far, too fast. Maybe they'd be looking at ways to slow it down. We saw a big sell-off yesterday, but today, again, a bit more recovery. Japan as well, another one to note because it's been rising even more than 1% at some points. We did see President Trump signing that executive order into effect, and Taiwan as well, one of the standouts, up more than 1% in the session, but the Taiwan dollar also leading the gains against the greenback today, and that's as we see, again, more foreigners pulling in or piling in to equities. Yields, as you said, we've seen that retreat in the 2-year yield, so again, we're seeing that reflected today in Asia. What's interesting is when I take a look again at what's leading in the session today, it's the same thing we've actually had for a couple of sessions now, which is Chinese solar stocks. So let's take a look at how they're performing today. Rising again. The story has been sort of this similar theme. There's this question now, is solar going to be really the first industry in China that tackles anti-involution or excess capacity through consolidation, curbing excess production? That's certainly been the hope, and we had that interview with Dakao's new energy CFO, for instance, who was saying words to that effect, and you're continuing to see, again, another day of gains for this sector.
Yeah. Belle, thank you so much. Belle Jewelers in Hong Kong. Well, oil prices are under renewed pressure, heading for a weekly decline ahead of an OPEC Plus meeting this weekend. The market is bracing for the possibility of another supply hike, even as inventories climb and demand concerns weigh on sentiment. To help us break down the outlook, we're joined now by Livia Gallarati, Global Crude Lead at Energy Aspects. Livia, good to have you with us. What probability would you place on OPEC Plus actually reviving talks or beginning talks about putting back the extra 1.66 million barrels per day that were taken off the market in 2023? Do you see that as a real possibility this weekend?
Yes, we do think it's a likely scenario at this point. I think there was initially reasons to believe that the group would be more on the cautious side and wait to see what the impact of the unwinding of the previous tranche of voluntary cuts would do to the market. But our latest soundings from the group suggest that actually they are very much considering unwinding that final tranche of cuts, the 1.66 million barrels per day that you've mentioned, sooner rather than later. And it could be as soon as October, maybe it's a little bit later, but it won't be well into 2026, as I think some of the market initially expected. Now, the key thing to remember...
Okay, so why? I was going to say, why do you think they will feel like the timing is right to do this? Because already we're talking about a backdrop, an oil backdrop that is pretty bearish. The oil complex is down almost 10% year to date.
Yeah, you're right. I think the expectations for Q4 and looking into 2026 is that the market will be building, and by a lot. At least that's what consensus balances are showing. The key thing is actually the markets haven't been as tight as balances have been suggesting. We haven't seen those big builds showing up yet. There is some expectations that they will come in September and October onwards. High frequency data is really not pointing to that just yet. And flat price has declined in recent months, but your structure, the backwardation of the crude market is still holding up quite well given we are pricing, the peak of refinery turnarounds. So all of that points to inventories being actually a little bit tighter than expectations. And the key thing is the production that OPEC has been unwinding on paper actually hasn't equated to a corresponding increase in exports to the market. So the market has actually seen a lot less supply that was supposed to be unwound coming to the market. And we think that's going to be a story carrying into 2026, even if this additional tranche of cuts is unwound.
Yeah, what is your own house view on that supply-demand mismatch? Because there are many, honestly, a whole range of forecasts out there, but most people and most of the research notes I see point to an excess supply of about anything from 1 million barrels a day all the way up to 2 million barrels a day, depending on whose research you're reading. What do you see?
Yeah, no, we are in that same range on spreadsheets, I would say. What we've been scratching our heads about, and I think a lot of people are in the same position, is that we're not seeing that coming to the market as data historically comes out, which as everybody knows, the data in the oil market is always very backward looking. We've actually seen demand outperforming expectations. Case in point, the U.S. print that came out just last week on demand was very strong, despite concerns about the macroeconomic backdrop, and supply is not keeping up pace, and that goes for the OPEC plus group. Places like Russia, they're really struggling to increase production, but even some of the Middle Eastern players and non-OPEC production as well is, I would say, generally underperforming expectations. So.
Interesting. Let me ask you about the Russia question and all of this, because it could go both ways, right? If there is a peace deal, it seems unlikely at this point, but assuming there is, that could potentially lead to a lifting of sanctions and renewed amount of Russian oil being supplied to the market. Alternatively, think to go the other way, and President Trump could decide to apply even harsher secondary sanctions on countries who continue to buy Russian oil. How do you trade the Russia factor, so to speak, in this market?
I would say at the moment, people aren't, in the sense that there isn't a lot of risk factored into the market with, the potential stronger sanctions from the U.S. government. I think because Russian supplies to the market have been resilient in face of, the EU embargoes and U.S. sanctions on the shipping sector, etc., the market is very skeptical when it comes to anything that might mean that Russian supplies are lost. So until there is a meaningful sign that actually something is happening and there is an impact on physical flows, I think there wouldn't be much reflected in the price.
And what do you think about these recent Ukrainian attacks on Russian energy infrastructure? Is that likely to show up?
Well, we have seen a lot of refineries in particular coming under attack from Ukrainian drones. It's nothing new. We saw that happening last year, but the scale and intensity of these attacks in August in particular, I would say was quite unprecedented. There was a lot of refineries that were struck down, and it has had a meaningful impact on domestic runs in Russia. It's curtailing product exports to the market. Interestingly, is not leading to higher crude to the market, which normally would happen if you have your domestic runs down. You just redirect more crude to the market. We think that speaks to the fact that Russian production actually isn't increasing that much on an upstream point of view. They are really struggling to bring the brownfield legacy assets to the market.
Yeah. Livia, thank you so much. Really good to chat to you ahead of this OPEC Plus meeting and beyond. Livia Gallarati, Energy Aspects Global Crude Lead. And coming up, hear why Citi remains bullish on gold, but is turning less bearish on copper as traders await key U.S. jobs data for fresh clues on the Fed's rate path. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Well, gold is on track for a third straight weekly gain ahead of a key U.S. jobs report that could cement expectations for a Fed rate cut later this month. Despite hitting overbought levels, the metal is still up by more than 30% this year, making it one of the top performing major commodities. Joining us is Max Layton, Global Head of Commodities Research at Citi. And of course, you just published your piece, an outlook for various commodities, not just gold. But I do want to start with gold. You know, we talk about the price performance in percentage terms, up 30%, but it's really difficult to get my head around the idea that gold started off the year trading at 2,600. We're now very close to 3,600, 3,500, thereabouts, all-time record highs. And yet, you remain bullish on gold. What is going to drive the next leg up from here? We've already rallied so much.
Yeah, that's a great point. There's absolutely massive spending on gold if we look at it in a historical context. You look at the value of the gold spending at the moment, and it is running at about $600 billion annualized, which is well over 0.5% of GDP, the highest in almost 50 years of data. So yes, there is a huge amount of gold buying. I think what takes it higher is that buying is set to continue. And so what the gold market's trying to do is it's these new buyers, the people who, they're buying for a variety of reasons, and we can talk about that, but the new buyers are trying to get the stockholders to sell. And on our estimates, you're trying to get a lot of stockholders to sell. Around 1% of total stockholders are needing to sell their stocks to clear this market, to meet that fresh demand to buy gold. So those stockholders, over time, the weaker hands sell and the stronger hands want higher prices. And that's what we're seeing. We're seeing gold kind of move up to get those stockholders to sell that marginal unit.
Yeah, to what extent is where we go from here dependent on what happens on the macro side of things? And let's say that the Fed don't end up cutting as much as priced in, or inflationary pressures don't emerge to the extent that perhaps some people in the market are anticipating. Does that constitute a headwind?
Yeah, it certainly does. And that's part of the reason why we only see a small amount of upside in the baseline scenario over the next 3 months. In that scenario, we do see prices getting up to $3,600. And that is because the FOMC has a dual mandate and inflation is above target. Yes, the growth market's slowing down, or the labor market's slowing down, but it's not slowing down dramatically. It's been slowing down for 3 years. The slowdown recently is kind of a bit of an acceleration in that. But overall, the US economy is doing okay, and the Fed has a dual mandate. So this is something that is going to be supportive here.
Yeah, Max, earlier in the year, we were talking about how silver wasn't enjoying the same rally as gold, gold's cousin, if you want to call it. But it's broken through $40 an ounce now, levels not seen since 2011. First of all, why did it take silver so long to catch up? And are you as bullish on the outlook for silver as you are for gold?
Yeah, I think the fact that gold got to record highs and it's gone up so much this year has resulted in some investors shifting into silver as a leveraged play on gold. So investment demand for silver has picked up in particular over the last 3 to 4 months. On top of that, you have a genuine deficit market in silver. And that deficit market has been ongoing for some time. It's not a true deficit, kind of like gold's deficit that we spoke about earlier. You're trying to price the marginal silver stockholder to sell their inventory to new investors, and they're requiring higher and higher prices as well.
Yeah. I want to switch over and talk about oil because we've got this OPEC Plus meeting coming, and I'm sure you heard our conversation with our prior guest. But I saw your view, the Citi Health view, is you're sellers of rallies in oil above $70 a barrel, but you're buyers sub $60 a barrel. So really, I'm guessing you see this target range of around 60 to 70. Why not more bearish? Because so many analysts that I speak to have started revising their forecast lower as we get into 2026 on anticipation of a supply glut.
Yeah, so the first reason is we're not seeing these bills to match the surpluses, the headline surpluses that we and it looks like a lot of other people are modelling of 1 million barrels plus. They're not showing up. And that makes you concerned that perhaps demand growth, the level of demand is higher than pretty much everyone is modelling. Or that, for example, China is stockpiling a lot of the surplus. And so what if the demand level, stays higher than it expects, or China continues to stockpile at the recent pace? If either of these things happen, then this surplus, not just last quarter, this quarter, it actually doesn't show up to the market in terms of OECD builds. That certainly our baseline is that China's been stockpiling a lot of the recent headline balance surplus. And if that continues, then we're not going to go as low as consensus believes.
Yeah, so interesting. I want to round up with a question about tariffs. And of course, now there are questions about the reciprocal tariffs, but not the sectoral tariffs, which apply to a lot of the commodities that you cover. Do you feel like markets like copper, aluminium, steel have now fully priced in the scale of the tariffs that were applied by the Trump administration, or there are still some dislocations?
Sure. So in the major metals that President Trump has spoken about, whether it's copper, aluminium, or steel, I think, yes, the market has priced the tariffs. But in the other metals, which are part of the Section 232 on critical minerals, that's where we could see some really interesting things over the next 6 weeks before that information comes back. In particular, palladium looks vulnerable to being tariffed, and that could see up to 50% upside in the COMEX palladium price. So that's silver as well, but more so palladium, given the anti-dumping concerns, given the concerns about domestic production having come down over the last few years due to low prices. I think that's an area that could be very interesting for investors.
Yeah, so interesting. Max, thank you so much for coming on our show and running us through some of your key outlook on some commodities per your latest report. Global Head of Commodities Research at Citi. Thank you. Now, coming up, a potential new deal on the horizon. Africa's largest wireless carrier, MTN Group, is considering reviving talks to acquire smaller South African rival Telkom. Details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Africa's biggest wireless carrier, MTN Group, is once again eyeing its smaller rival, Telkom, in South Africa. Sources tell Bloomberg that the two companies are considering reviving takeover talks before the end of the year. For more, we're now joined by Bloomberg's Lonnie Prinsloo. Lonnie, quite simply, why is MTN reconsidering a takeover of Telkom, and why right now?
Morning, Giovanna. Thank you. Well, basically what happened is the biggest telecom operator in South Africa, specifically Vodacom, managed to get a deal through for fiber with Remgro after many years of being stuck with the competition authorities. And it sounds like this has just given them a bit more confidence or a bit more hope that some sort of deal can be done with Telkom, specifically looking at fiber, it sounds like. And then the other thing is also the government has been a bit more vocal on they want everyone in South Africa to be connected in 5 years. So that's quite a short time span. And companies are arguing that if you want that done, we need more consolidation to make that commercially viable.
Yeah. What have been some of the hurdles in the past to making a deal happen, though?
So as I said, South Africa has quite a strict competition authority, and that has been the biggest concern. There were also, once the talks were going between MTN and Telkom the last time, there were some concerns over exclusivity of the talks, because all of a sudden everyone came forward and also wanted to talk to Telkom about a possible merger or consolidation. There was Rain, there was the previous Telkom CEO, Sipho Maseko that was also interested. So yeah, so then there were a few concerns, and in the end it fell flat. But I think it was mostly the competition concerns the previous time.
How big of a deal would this be for South Africa?
So in terms of just what South Africa is busy with currently, they are thinking about starting to reform 3G. People want the rural areas to be connected, but specifically with 4G and 5G. So you need fiber infrastructure to get there. It's expensive. And so that's why we saw that deal between Vodacom and Remgro. And MTN also now, I think, feeling that they would need the extensive fiber that Telkom actually has, and Telkom also quite a big player, number 3 in the market. We are not sure if they will be a willing seller, but we'll see how these round of talks go if they launch it. There was also a previous thinking about relaunching talks that didn't happen. So but it sounds like consolidation is maybe required or at least sought by the telecoms operators in the country.
All right, a story we'll continue to watch. Bloomberg's Lonnie Prinsloo, thank you so much.
Thank you.
Billionaire designer Giorgio Armani has died at the age of 91. Armani established his namesake brand in 1975 and created a retail empire, selling everything from jackets to sunglasses and shoes, and became a cultural phenomenon. The Italian patriarch entrusted the future of Giorgio Armani to close family members and associates who will map the next steps for a company. A fashion legend, Giorgio Armani, dies at 91. And that's it for Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.